We live in a fantasy world now. Reality has been destroyed.
This is the time that we really need to pay attention.
The probabilities are overwhelmingly on gold's side. That is the best environment to see gold increase its value.
Welcome to Palisade's Gold Radio. I'm your host, Tom Bodrovics. Joining me today is Jonathan Davis, economist and wealth advisor. How are you today, Jonathan? Thanks for joining me.
I'm very good, and I can assure you it's my pleasure, Tom.
Well, I appreciate you coming back on the show. You know, it's been a little while since you and I have spoken, and you recently wrote in your Booms and Busts report that those who cannot remember history are condemned to repeat it. So are we seeing parts of, let's say, 2008 start to repeat itself with the bank failures that we have seen in the first part of this year already?
Indeed, yes. You've hit the nail on the head. There are so many similarities to 2008. 2023 is likely to be, depending on your point of view, as bad as or as good as, depending on your positioning, as that year, that couple of years, really. This is a huge risk-off environment that we are now in.
Mm-hmm. So do you think that any of the central bankers get their interest rates over their inflationary numbers at this time, or does this cause so much damage that they have to acquiesce to the cracking banking and financial systems before that time?
Who knows what central bankers know or believe?
Mm-hmm.
It's as bad as some of these guys in the mainstream media who talk their own book, talk their own agenda, their portfolios, their positions, and they're totally wrong. Of course they are. Inflation is transitory. What a laugh. Indeed, this week, Jay Powell said in his presser that there's more likely not to be a recession than that there will be, even though we'd heard recently, that they did expect a mild recession. Well, that is as bad as 2008, when Bernanke said there isn't a problem in financial markets. I mean, that is such a wrong statement. There is more likelihood of a recession, an economic recession, and indeed another major leg in the markets down, mm-hmm. than there is no likelihood. So it's the exact opposite of what he said. Goodness knows what they believe, what they know. They totally get it wrong all the time. Look, they have their agenda. They have their political masters. They have their political agenda. But what they're not doing, and central banks, I would say, never have done this. They do not manage economies, which, of course, is what the mainstream media want us to believe, and the politicians want us to believe. Goodness knows what their objectives are, but it's not what they say they are.
Mm-hmm. Well, you know, I've made the point several times on the show that it seems like they're looking at false data. You know, the Fed always says they're so data dependent based on, you know, the jobs market, CPI, all of these things. How do you see the data picture that all of these central banks are so reliant upon?
Well, you know, take the Fed. It's arguably, and I think reasonably, the most important central bank on the planet. What is it? Is it 400 or 4,000 PhDs that work for that organization? Talk about academics who couldn't find their way out of an envelope, or should I say, post an envelope, I think is the phrase, as someone said to me a couple of months ago. Yes, it would appear that their focus is the inflation statistic, and there's no question it's still whatever developed country you look at, whatever central bank you look at, the inflation stats are way above their own, and we should say illegal 2% inflation target. No one's ever said by their parliaments that 2% is what the target should be. So that's why it's illegal. So we know that inflation's still much higher. We also know that unemployment is very, very low still. So on that score, we understand why globally central banks have been raising interest rates. However, the data that I have, and I'm sure many of your listeners have, what viewers have, is that the economy is slowing. We know for a fact that unemployment has started to tick up. Certainly, the number of jobs available has fallen, not necessarily heavily, but significantly, statistically significantly. And of course, inflation in the US has been falling since June last year. And where I am in the United Kingdom, since October of last year. So clearly, inflation is sorting itself out. But of course, the central banks are way behind the curve. And they are certainly not looking forward. They're still looking in the rearview mirror.
So how do you see that inflationary picture going forward? And is there, let's say, a material difference between the US, the UK, the EU? You know, how do you see that inflationary picture developing over the next couple of years?
Yeah. Well, you know, Tom, we are rapidly heading to a global economic recession. If we're not already in one, the leading economic indicators suggest we might already be in one. But I think we need to see higher unemployment, although clearly it's rising. And certainly, I think you're in California.
I'm in Canada,
big,
actually.
I beg your pardon. Okay.
Not a problem.
The big tech, the mega tech companies have been laying people off in material numbers. Okay, you know, we're not talking about half the company, but, you know, 5, 10, 15% of the companies. Of course, the crypto companies have had great problems, rightly so, because in many cases been pure fraud. So hopefully they're investigating that, and there's going to be some prosecutions. But you know, I'm just talking about the unemployment picture. So, but you know, that's the same practically wherever you look, and inevitably when you have mortgage rates and commercial borrowing rates rising so far and so rapidly in the space of 12 months, when you've got huge borrowings on 2-year bases, and then they have to be reset. In America, what is it? $1.5 trillion of commercial real estate is going to have to be reset at materially higher interest rates in the second half of this year. Oh my goodness! And as I wrote also recently, I see that in America, talking about commercial real estate, the vacancy rate before we have an announcement of a recession is at 2008 levels. Well, you know, where's it going to be when we get a recession announced and unemployment is really rising dramatically? Well, you know, clearly the signs there are of an imminent recession. And there's lots of other signs which we could look at. But, you know, let's talk about the market, shall we? Mm-hmm. Let's talk about interest rates, which, of course, has a chicken or egg. Is it affected by inflation, or does it affect inflation? But you might post some of the charts that I sent you. Mm-hmm. You know, let's look at the daddy of all interest rates, which for me is the US 10-year. From the spring of 2020 to the autumn of 2022, global long-term interest rates absolutely soared. In the US, it went from under 0.5% to nearly 4.5% in 2.5 years. And that, of course, is the reason why subsequently the central banks raised their short-term rates because they could hold it no longer, because the long-term rate had already risen. This idea, for some of your viewers who are not so sophisticated, who are perhaps newer in the markets, the idea that the central banks manage interest rates. No, they are reactive to what happens in global market rates. So there's the chart there showing the last 20 years, but just focusing on the right-hand side of the chart. As I say, the 10-year soared for 2.5 years. Mm-hmm. But very interestingly, as I say, CPI in the US peaked apparently in June, and as far as I'm concerned, it did peak for the economic cycle, and it's been falling now for months. It could, in any of the individual inflation stats that we now get month on month, the month on month could rise. It wouldn't matter. The trend in inflation is down, and look there, since October, the US 10-year has been trending down. Now that's 6 months now, over 6 months. And the numbers are, in the peaks, we saw 4.3% in October. We saw 4.1% in March. We saw 3.6% in April. In other words, lower highs, following from falling inflation. And as most will know, but some might not, the simple arithmetic is, as bond yields rise, bond prices fall. And as it says in black there, and vice versa. So the interest rates have been falling for the last 6 odd months. Thus, bond prices have been trending up. Mm-hmm. And, my clients are retail clients, largely in the UK. I have some clients outside of the UK who have UK assets. And also I have some people who subscribe to my client-only updates. You mentioned the booms and bust report. That goes to anyone. So, anyone can access it by just going onto the website, jonathandaviswm.com. But I'll tell you that our clients, our retail clients, are very heavily invested now in their portfolios in long-dated US Treasuries. Why the US? Because if we're heading to recession, and US deposits are now paying, well, if you get into the right banks, that is, they're now paying 4+%. Well, that's 4% easy money. And if it's a recession and a stock market crash and a commodity crash, then you're going to see global investors run to the dollar, which is A, going to soar, and B, they're also going to run to the likes of TLT, which is the long-dated Treasury ETF. So our money is where my mouth is. We're heavily invested in US Treasuries, and I think there's still an opportunity to get in at today, roughly 3.3%, because that lower horizontal line is around 1.5%. The red line is at the 200-week moving average. It wouldn't surprise me if we go sub 2%, perhaps sub 1.5%. That's big money to be made in a few months.
So, Jonathan, when you're talking about being in long-dated treasuries, what do you see as the risk of that capital, in some ways being destroyed by, depending on your time frame, by inflation versus the coupon that you're earning on it?
Sure. There's almost no risk because one is not talking about holding these bonds for a long term. On the contrary, I'm talking about as a short-term investment while waiting for the next leg down in the stock market and in commodities. Mm-hmm. In other words, a major risk off. And you said it right at the beginning, bank after bank, medium-sized bank after bank in the US is going bust. Credit Suisse is at a bailout, $50 billion. So reminiscent of 2008. The dominoes are falling one after the other. Commercial real estate, corporate profits are falling, unemployment's rising. This is classical economic and markets recession. And if people aren't taking advantage of it, if they're staying in risk on, well, that is the risk. The peace of mind that I have and my clients have is that we are massively risk off in our positioning.
Mm-hmm. So, Jonathan, how do you think we've gotten to this point here? With the markets, has it just been complacency or recency bias by the market participants, or has it been, the actions of the Fed that has just trained them to stay bullish regardless of these risks that are presented?
I take issue with the idea that the markets are bullish, just because if you look at the major indices, say the S&P and the Nasdaq, yes, they have risen, of course, for 3 months or so, maybe 4 months. Mm-hmm. But these are big indices. I can tell you that 7 or 8 of the mega cap companies in the S&P 500 have been keeping that index alive. Mm-hmm. All the others, 494 or so, are down either a little or a lot. Mm-hmm. From where they had been in December, which is generally accepted where the takeoff took place. So, we've got Apple quarterly numbers coming out imminently. I don't know if it's tomorrow or next week, but I tell you, that's 7% alone. Mm-hmm. Of the S&P 500. And everyone's looking to Apple. And I tell you, if it doesn't have absolutely blowout numbers, I think the S&P is going to be, and the Nasdaq are going to be hit hard. But, even if it does have blowout numbers, it doesn't change the fact that generally corporate profits are falling year on year. Mm-hmm. Unemployment is rising. Mortgages and commercial loans have to be reset by the trillion. Inventories at retailers are soaring. I don't know if I said it in this list. Again, unemployment is rising. And the fact is, long-term interest rates are falling, which means simply that someone out there is buying long-dated treasuries. That is hardly bullish action.
Mm-hmm. So, Jonathan, when we think about another leg down in the stock market, you believe that the precious metals and commodities in general are going to get sold off in that scenario as well. So, do you?
Well,
go ahead.
Yeah. Well, scroll down in those charts, please, mm-hmm. to commodities. Look at the commodities ETF, which you'll pull up any moment. There you go. A bit further. That's it. So on the left there, you've got the 2008 peak in commodities, oil at $147. Of course, they crashed for many years. And for several years, it went nowhere. We had the deflationary shock in early 2020. And just as I've been describing and showing that long-dated interest rates soared for a couple of years, commodities, as we know, soared for a couple of years. But look, since a year ago, the commodities index has been falling. Mm-hmm. This, of course, is disinflation. So, yes, I expect there to be further falls in commodities. In the short to medium term, in the economic recession. And indeed, please scroll down to the next chart. Look at the big daddy. It's 40% by value of all commodities. It's crude oil, West Texas. Mm-hmm. It's practically halved in the last year. It's gone from $130 to the high 60s. And yet we've heard, I mean, you've had interviewee on one after the other saying how strong the oil market is, how oil's going to $200. Well, I can tell you, I and my clients got out of the energy space in the late spring of last year. Mm-hmm. And, you know, that isn't to say the oil isn't going to come back, because it will. You can see I've got this blue, down and up tick, but it needs a bit further to go. And I believe it will go further. Whatever commodity you're looking at, copper, wheat, oil, we'll talk about precious metals in a second. They're all in a state of collapse. Why? Economics 101, there's less demand than supply. Now, after the crash, we will go back into a bull market for risk on assets, the stock market, commodities. But the trend is clearly down. And people should look at what is rather than what they want it to be, because that, of course, is far too prevalent in the investment world. And I believe that I've discussed that with you in the past. Scroll down further to gold. It's 2 charts down.
Before we move on, Jonathan, I just wanted to ask you if if this sinking and you said kind of crashing condition for commodities and oil is because of lack of demand, going into this seemingly worldwide recession.
I think it's simply that if you look at manufacturing, which of course is a huge user of energy, manufacturing, according to the economic statistics, the surveyors have been in contraction for months. Certainly Germany, the second largest country manufacturer, although actually, I beg your pardon, maybe America's a second, but you get the point. It's China, then America or Germany. Germany has been in contraction manufacturing for the best part of the last year. American manufacturing is in contraction. Even Chinese manufacturing is in contraction. I laugh at, the energy bulls who were telling me, and everyone else, about China opening up. They were telling us it for months. Every day they tweeted it. Frankly, I really didn't enjoy it, watching it and reading it. And some of these guys have blocked me on Twitter, which is incredibly egotistical and childish of them, because all I did was state economic facts to them. But of course, they're there selling their funds. Now, I've got nothing to sell your clients, who are basically in North America largely. I'm sure there are some elsewhere, but I'm just telling you, and I tell my clients, and if they follow me on Twitter as well, I say it as I see it. That doesn't mean I'm right all the time, of course not, but at least I say it as I see it, and I'm not a perma bull or a perma bear. I go with the flow.
So what do you think was wrong with that thesis that China reopening is going to be so bullish for all these commodities?
They misunderstood what the Communist Party and Xi was trying to do there. First of all, of course, China got it totally wrong in imprisoning over 1 billion people for as long as they did, and that was quite disgusting. That, by the by, in fact, we got it wrong by locking up as many people as we did in the West, and that should never have happened in the first place. But just getting back to China, the the primary reason why China locked all those people up for that long was nothing to do with a medical issue. it was to do with their economy. You have to understand that China is turning Japanese. China is like Japan in the late 1980s. It is going to go into a huge debt deflation depression, just like Japan did for 20 to 30 years. China has $50 trillion of debt. You think the US is bad? China's a great deal worse. So that's the reason why China locked everyone up, because they had to stop borrowing money and just rethink what the hell they were doing. So the reason why the opening up hasn't gone well is because the economy is toast.
Mm-hmm. So you wanted to move on to gold here, how you see that playing out for the next.
If you scroll down, I know this is a particular interest of yours. Very interesting chart that I've produced for your viewers there. We know, of course, the bear market from 2011 to the end of 2015. So I've started this chart at the beginning of 2016. In gold is gold, or the artificial gold, the ETF GLD. But it roughly, it's a good approximation for the physical. Mm-hmm. In black is just a juniors fund that I have used from time to time in the UK. But as you can imagine, it's very similar to, say, GDXJ or a North American fund. Mm-hmm. But and red is the 200-week exponential moving average, which is the thing that I use. How fascinating is that chart? Gold is like the tortoise. It's just gradually building, gradually. And at this point, I have to read more closely myself. So they're both debt after, what's that? Is that 17 or 18 years? 16, 17, 18, 19, 20, 21, 22. After 7.5 years, they're both coincidentally up about 80%. Mm-hmm. Which is what about 9 or 10% per annum compound ultimately. But look at the juniors. They're like the hare in the tortoise and the hare. They go crazy and then they go to sleep, or they have a heart attack for years, and then they go through they get a defibrillator and they come alive again, like in the Hollywood movies, mm-hmm. and they go crazy again, and then then it goes beep 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 again, and it slows down, it goes backwards again, and I find that absolutely fascinating. So yes, since the autumn of last year, gold probably restarted another bull market, and we've seen it go up a few $100. The miners haven't done much yet, as you can clearly see, because investors should know first and foremost the miners are companies, and the fact is the stock market outside, as say, of the big seven are simply not doing very well. Look at the Russell 2000; it's not doing well. Quickly, please scroll up. Yep. You keep going, and again. Yep. So the UK equivalent of the Russell, mm-hmm. As you can see, from the middle of 2011, went down a third. Yes, it went up to the 200-week moving average, but as far as I'm concerned, it's trending back down again. And that's broadly similar to the Russell 2000. Let's go back down to gold again. So I think smaller companies or mid caps are still trending down big time, mm-hmm. As indeed are gold miners. In the next major risk-off event, which I will tell your viewers could happen within days or weeks or a few months. I think if it doesn't happen by July, then it's not probably going to happen in July and August, simply because not many things, big things happen in the summer months. And think back to 2008, Lehman's and AIG was September, October, and that's not much of a surprise. But it could happen by next month. As I say, all of these banks going under, it's very similar to what happened in the second half of 2007 and the first half of 2008. And then we all went to sleep, basically, nothing much happened. And then boom, in the autumn, it all crashed and burned. But so people should be aware something could hit the fan within days or weeks or a few months. As far as I'm concerned, it will happen by October. As to exactly what it will be, haven't the foggiest.
Yeah.
But something's going to happen. It's as clear as daylight. And when it happens, as opposed to if, in my opinion, gold will come back 10 or 20%. Now, in the meanwhile, it's entirely possible that gold could go up 10 or 20%. It could go up to 2,200 or 2,400. It's possible. I don't expect it, but yes, I'd give it a 25% probability. So it has a reasonable possibility. I think, however, if you scroll down to the dollar index, the DXY, there's a long-term chart of the dollar, clearly trended down for decades. But the fact is, it's been rising since 2021. It then had a normal, common or garden, sizable correction for the last several months, which you will note took us to about the top of that rectangular channel, that rectangular box. And I'm not surprised that, people can look at that chart in more detail on their own, and they can scroll in and see it more clearly. But it seems to me that we have seen a double bottom in the gold, in the US dollar. And I do believe that, particularly with an economic recession, with a markets crash, a risk off, and bonds rise, the world and his oyster are going to run to the dollar, as they always do, and they're going to run to US Treasuries, particularly long dated. So yes, I think the dollar will rise materially, and in that, I think gold will fall. I don't see it going to 2,200, 2,400. It is possible. I do see it being sub 1,800 at some point this year. And of course, the miners will also crash. That, scroll up to the miners and gold, that will be a phenomenal buy for, on the face of it, if history is anything to go by, for 3 to 6, maybe 9 months in juniors, you could make 100 to 300%.
So, Jonathan,
long term, yes. I see gold trending up long term, certainly into the 2030s, but not in a straight line. So what does?
Of course, yeah. And I think it's important to make that distinction, being, let's say, bearish for the short term and, ultimately bullish. But do you have any type of an explanation for why the miners are not gathering any attention? Or is it simply that when gold gets a lot of attention, this momentum comes into the sector and chases the miners higher?
Yeah, I think the second point is the case. When gold is clearly strongly bullish, then market participants see a relatively short-term opportunity to really make serious money out of the miners, particularly the juniors. Why the crash in the last few years in the miners? Well, they just went up too far too fast. Clearly, they shouldn't really be going up materially more than gold in the long run. It's either short-term speculative money or dumb money, frankly, that chases it, and then they get hit hard when the market makers see the opportunity to take it the other direction. Why haven't miners risen in the last 6 months since gold has been rising? Well, it has a bit, as you can see, depending upon your start point. But as I say, first and foremost, they are small companies. And quite simply, the market doesn't believe there is yet sustained strength in precious metals. That's how I read it.
Mm-hmm. Jonathan, one of the other things I wanted to go over with you was your following of uranium here. Is that a theme that you see playing out as, let's say, public opinion changes more positively towards nuclear power?
Yes, in the long run, sure. In the short run, Japan is reopening, which is fantastic for this industry. I heard an interviewee on a podcast, a well-known guy, but no names and all that, say the phrase I think he used was China's opening a new plant every week, which I thought was a lovely thing, and it's probably true. Um, um, on the other hand, of course, stupid countries, particularly in the West, are still closing nuclear plants. Germany just is. I smile, but I'm smiling wryly because it's hurting the people, left, right, and centre. But in the short to medium term, let's look at the chart. It's more complex. Black is Cameco. And particularly on the left-hand side, we see the mega bull of 2003 to 2007. And if you then now look on the right-hand side y-axis, which is the Cameco price listing, in orange, it's a UK fund, one of the UK funds that I use, which only started in 2009. So we can't obviously show the 03 to 07 mega bull. And the left-hand y-axis is the GCL price listing. So clearly, unsurprisingly, the charts are very similar. Not literally in the last few months, though, which is very interesting. There's been a strong divergence. Cameco is very strong. The fund, which includes a lot of other small miners producing and non-producing, and incidentally Kazatomprom, and uranium itself, has not picked up, whereas Cameco has. I find that very interesting. However, once and more interestingly, and interestingly as well, from the spring of 2020 to the spring of 2022, whatever Cameco fund Cameco did, funds of miners and uranium, in particular this one, went up 600% in 2 years. Then it has done a normal, sizable correction of 50%. Well, I didn't think it would correct to that extent. I am a hodler. I admit I'm a hodler. Because, GCL is now just under 40. It was just under 80. I see it going to 200 once the bull market reasserts, and I'm absolutely sure in my mind that it will, because the demand supply is still as clear as daylight. But again, these are shares first and foremost. And smaller companies generally have just not been doing well.
Mhm.
And again, after a 600% rise, we should expect a correction. 50%, it looks to me as if it's a double bottom. You can see that quite clearly. We might see lower. I don't expect it. I don't care. I'm a hodler because of the macro position for uranium and clearly the need for more and more electricity and energy in the medium term. So if we're at roughly 40 just now, well, simple numbers, I'm expecting a 400% rise from where we are now in a fund of uraniums over the medium term, which is what, roughly 2, 3, maybe 4 years.
Mhm.
On verra.
So when we're looking at that type of bull market, from 03 to 07 there, 03 to 08, do you think that a grinding, more gradual bull market is better for the miners and the industry as a whole, and more of what you want to see rather than this very spiky, volatile type of market?
Right. Well, we saw a huge, highly volatile upswing for those 2 years, 600%. You can't do much better than that. And yes, it's been down and up and down and up for just over a year now. But actually, if you were to draw a channel, you would see it's horizontal. You see a 1, 2, 3, 4 peaks at more or less the same level for Cameco, and 3 peaks at more or less the same level for the Orange Fund. And similarly, you see 3 bottoms at more or less the same level in the mid to high 30s for the Orange Fund. So no, it's a horizontal channel. It's just a normal correction. It's waiting for the next move up. I don't expect it to be gradual. I expect the next move up to be hugely volatile. Again, I'm expecting 400% within 2 or 3 years. I mean, that's not gradual. That's enormous. And we, all my clients and I, we are heavily invested in. Yes, it's hurt us in the last year, but we made a lot of money in the prior couple of years, and I believe we'll make a lot of money in the next 2 or 3 years.
Mm-hmm. As you say, if you're a hodler, you're prepared for the long term and that eventual spike up.
Indeed, I don't believe it will be the long term, and I wouldn't be surprised to see it tie in with the ending of the economic recession and the inevitable multi-tens of trillions of printing, and the reflation, and the demand for energy, and it will be hugely risk on, and everything that you can imagine that will be risk on should do exceptionally well, as it did from the spring of 20 to about the end of 21, the middle of 2022.
Mm-hmm. So in that, let's say that reflationary period, is that part of, a deglobalization theme as the world needs to, re-onshore, or at least the West try to re-onshore manufacturing, increase power demand, that entire piece, and then how do you see it playing out from there? Because as you said, that is, obviously going to be funded by a massive amount of printing. However, that seems in and of itself like it can't have a happy ending.
We had decades of falling inflation from the late 1970s to literally the end of 2021. Mm-hmm. And that happened because largely 2 issues. One, the Amazon effect. So more and more online um, 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 economy and logistics, and also simply because of China. Not just globalization, but specifically China, which, of course, just like Britain became the manufacturing workshop of the world in the 18th and 19th century, so did China in the late 20th and early 21st. So certainly the politicians have decided to separate from other countries that they don't like. Russia, the obvious one. China's the obvious one. Problematically, and you know, this could add, my God, to the inflation story. But if it happens, it will be the least of our problems. You know, Western politicians seem to be creating World War III. I mean, it's remarkable. Um, um, and if that happens, you do want to buy every kilogram of gold that you can possibly lay your hand on. And of course, don't tell anyone that you've got it. That scenario currently is unlikely, but my God, it's increasingly possible. China is losing its place as the manufacturing workshop of the world. Now, other countries will, of course, take over. It's not just reshoring to the West, it's also friend shoring. So, you know, there's Mexico, Indonesia, Vietnam, and so on. Don't look to India, because India seems to be siding over there because, unsurprisingly, Russia's happy to sell it cheaper oil. So, you know, what are you going to do if you have politicians who actually care about your country? So the coming away from China manufacturing is of itself not necessarily going to be inflationary. But what it will be, it will stop the deflation that China was giving us, gifting us one of the greatest economic gifts we could imagine. Our lifestyles were getting better because we were buying stuff cheaper. So it'll stop the reducing cost, and overall there'll be some reducing cost, but some rising cost. So that, you know, added to the fact of the quantitative easing and the commodity increases for years, if not decades, then yes, that will bring about inflation. But particularly, it will be the debasing of currencies over the next 10 or 20 years that will bring us higher inflation than we have seen for decades. You know, for in the UK, I can't specifically talk about the US, but it won't be dissimilar. In the UK, until 2021, we had 30 years of sub 5% annual inflation, in which 28 were sub 3% inflation. And that will be similar in North America, of course. So we have moved from an era of falling and extremely low inflation. We are now in an era of 10, 20, possibly up to 30 years of not necessarily rising inflation, but certainly materially higher inflation than we had. And although, as I said earlier, strongly that we're currently seeing falling inflation, it will stop at a level higher than we had in 2021, and then it will start rising again. and it's primarily because of the money printing, the debasing of currencies. The US dollar is the one that everyone looks at. When is the dollar going to debase? Well, it will, as will all currencies, but the dollar will debase less than everything else. That's why the DXY is probably going to rise in the short to medium term, and actually may also rise in the long term, but fall against commodities and gold.
Mm-hmm. Well, Jonathan, I think a very succinct way to wrap things up there. That was a perfect way to put a point in it. Is there anything else that you wanted to add before we do?
I want people to think on history. You quoted, or you used my quote from George Santayana. Those who don't remember history are doomed to relive it. I'd like you to go back to those charts again and look at the Dow Jones just below the interest rate chart. This is the Dow Jones from the early 60s to the early 80s. So the early 60s to the early 80s. And as many of your viewers will know, the early 80s is when we started the 40-year mega bull in the stock market and in government bonds. They both went up for 40 years. But what happened economically in the late 60s and 70s? We had huge inflation. I call it superinflation. Many of your viewers and interviewees call it hyperinflation. Arrant nonsense. Hyperinflation is Venezuela and Zimbabwe. It's superinflation. And yet the Dow Jones in those near 2 decades did nothing. So think about that. If you were a stock market investor for nearly 2 decades during huge inflation, your wealth was reduced massively, your purchasing power. And I believe that we are now in a similar era for the stock market generally. So that's why, at the right times, you should be in the market, the stock market, and you should be out of the stock market. Similarly, you should be in government bonds, in risk off, and then out of government bonds, in risk off. And generally speaking, you should have a focus on global smaller companies and commodity companies like the energy companies, the miners, when you're in risk on, but no reason why you should be in them much or at all when you're risk off. People need to take a much more active approach. That's the one thing I wanted to add.
Yeah, it seems many of my guests seem to agree on the fact that you need to be an individual stock picker and very active versus just holding a 60-40 and, being invested, period.
Well, the 60-40 is dead. It worked. It's dead as an investment strategy for normal investors. But you know why 60-40 is still there for 99% plus of all portfolios? Because it's great for the wealth management industry.
I was going to say commissions for the financial products.
Indeed, and fees for the fund managers. I would say I'm not a stock picker. I'm an asset class picker. I don't invest in individual issues. I invest in funds. As I say, I'm investing in bonds. I'm investing in uranium generally. And when I go back in, I'll invest in energy companies generally. I'll invest in minor funds. I'll invest in global smaller company funds. I myself, I don't see the point in investing in individual companies, really. It's too much hassle. You can do very nicely by just picking the right asset classes and moving in gradually and moving out gradually when you see things happening in one direction or t'other.
Mhm.
You don't have to make major moves in one go because nothing happens overnight. And that's another thing that people, you've got to make a move right now because something could happen tomorrow. Well,
Mhm.
if it does, then make a move. But you don't have to transform 100% of your portfolio. You can do 25% and then 50% in 3 days or a week, and then another 25%, and do it in big chunks, in funds. And that way, you're not overawed by what's happening. You can actually think clearly about what's happening. And when you make a move, you can do it in one click of the button.
Mhm. Yeah, by having a fund, you're kind of diversifying some of that risk.
And at the same time, if that asset class is in a bull, you'll do very well. And
Mhm.
if it's in a bear, then you can get out very easily.
Mhm.
People should think about funds. Um, Everyone talks about individual, this company and that company. Yeah, of course, I get it if you're really good at what you're doing. But frankly, if you look in the mirror and you're not that good, then stick with the funds.
Yeah. Yeah, and unless you have some type of informational advantage, it doesn't seem that you're
Okay,
you're going to be able to be, as you say, that good, right?
that's my position
Excellent.
from many years of experience.
Mhm. Excellent, Jonathan. Well, I want to thank you for, sharing your ideas with us today. Of course, you're available, your website, jonathandaviswm.com.
W
And as
Davis
you said,
W. That's right, JonathanDavisWM.com. Yep.
mhm. And as you said, the booms and bust report are available for free on your site and signing up to get them directly, right?
Yep. And on Twitter, I'm at Jonathan Davis, where the O is a zero.
Absolutely. Jonathan, thanks so much for your time today. Really appreciate it.
Thank you, Tom. All the very best. Good luck.
You too. This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.